All right, let's get right into it. Today, we're talking about one of the most important tools in all of business, the balance sheet. Now, I know what you might be thinking, boring, right? But forget all that. I want you to think of it like this. It's a single, powerful photograph, a financial snapshot that tells you almost everything you need to know about a company's health at one specific moment in time. So, imagine this. You see a company and they've got it all. The flashy glass office, the top of the line equipment, everyone's busy. They look like they're absolutely crushing it. But are they? I mean, really, how do you know for sure if all that impressive stuff is paid for? Or if they're just sitting on a huge mountain of debt? Well, that's where the balance sheet comes in. It's the tool that gives you the real story. The source material calls it a screen picture of a company's financial position, and that's a perfect way to put it. It doesn't get distracted by the fancy furniture, it just gives you the cold hard facts. It tells you exactly what a company owns and exactly what it owes on one particular day. Now, to really get this, we have to understand its most basic principle. See, there's a reason it's called a balance sheet. It's all built around this one fundamental, absolutely unbreakable rule of accounting. It's a balancing act. Okay, so on one side of this act, you've got the assets. Pretty simple, right? This is all the stuff the company actually owns. We're talking cash, buildings, machines, basically anything that has value and can help make money in the future. It's all the resources they have to work with. And on the other side, well, that's where the money for all that stuff came from. These are the claims against the assets. This side has two parts. First, you have liabilities, which is what the company owes to outsiders, like banks or suppliers. And second, you have capital, which is the owner's own stake in the company. And here it is, the unbreakable rule in action. Everything the company owns, all of its assets, has to be perfectly equal to all the claims against it, the liabilities plus the capital. And it makes perfect sense when you think about it, right? Every single asset had to be paid for somehow, either with borrowed money, which is a liability, or with the owner's money, which is capital. The two sides just have to be equal. They always balance. All right, so now that we get the big picture, let's zoom in a little bit. Let's take a closer look inside the snapshot and see what kinds of things actually show up on each side. When you lay it out like this, it's pretty straightforward. On the one hand, you've got your assets, all the valuable things the company has control over. On the other hand, you've got the liabilities, all the money it owes to other people. It's a simple, powerful comparison, what you have versus what you owe to get it. So let's get a little more specific. Under assets, you've got the obvious ones, right? Cash, machinery, buildings. But you also see things like closing stock. That's just a fancy term for all the inventory you haven't sold yet. And then there's goodwill, which is really interesting. It's an intangible asset. It represents the value of things you can't really touch, like a stellar brand reputation or a loyal customer base. Now, over on the liability side, you'll see things like sundry creditors. Again, just a formal way of saying money we owe our suppliers. And of course, bank loans and overdrafts. But what's really key here is that capital is also on this side. You might wonder why. Well, from the business's point of view as a separate legal entity, even the money the owner put in is technically a claim against its assets. It's money the business owes back to its owner. Okay, so we know what's in the snapshot. But just like with a real photo, the way you frame it can totally change the story it tells. And with a balance sheet, there are two main ways to frame or organize the information. And this whole process of arranging things in a specific order, it actually has a name. It's called marshalling. It's just a simple way of saying you're putting the assets and liabilities in a very particular sequence to highlight different things about the company's finances. The two main ways you can marshal a balance sheet are by liquidity or by permanence. If you organize it by liquidity, you're putting the items that can be turned into cash the fastest right at the top. This is super useful if you want to know about the company's short-term health, like can it pay its bills next month? On the flip side, organizing by permanence lists the most long-term, stable items first. This gives you a great sense of the company's solid foundation and its long-term stability. And here's a great example of that liquidity approach. See how cash in hand is right at the top of the assets? Well, you can't get any more liquid than cash. And on the liabilities side, bills payable are up top because those are the debts that have to be paid off the soonest. This whole layout is designed to answer one question: how much cash can we get our hands on, and how fast do we need to pay our bills? But watch what happens if we re-marshaled these exact same items for permanence. The whole thing basically flips upside down. Now, the most long-lasting assets, like goodwill and land and building, are at the top. And on the other side, the owner's capital is listed first because that's the most permanent source of money for the business.
This view is all about answering the question, what's the long-term stable structure of this company? So after all that, we get to the big question. Why does this one snapshot matter so much? What does it actually tell us?
Well, it really comes down to three huge advantages. First, you get a super clear, organized picture of where the company stands financially. No guesswork. Second, you can start to really analyze its health. You can ask important questions, like are its assets mostly paid for with the owner's money or with debt? And third, it lets you figure out the business's net worth. You just take what it owns, subtract what it owes to everybody else, and what's left is what the business is really worth on paper. That's an absolutely critical number for any owner or investor. But, and this is maybe the single most important thing to remember, I want you to really let this quote from the source material sink in. A balance sheet is true only at the point of preparing it and not later. It is a snapshot. It is perfectly accurate for that one split second in time. But the very next day, the company makes a sale or pays a bill, and poof, the picture has already changed. Its static nature is both its biggest strength and its greatest weakness. Which, of course, leaves us with one final question to chew on. If this incredibly powerful tool only shows us where a company stands on a single day, then how do we ever understand the full story of what happens between those snapshots? What happens the day after or the month after? And that's the question that takes us beyond the balance sheet and into the rest of a company's financial life.